There have been a lot of rumors going around that the stock market is going to crash in 2021. Some argue that the whole stock market is overvalued, that it's in a bubble and the bubble's gonna burst. Others think that a coronavirus strain is gonna come out that sends us all back into lockdown. No one really knows when the next crash will be, but you should always be prepared to take advantage of a market crash. In today's video, I'm gonna talk to you about how to prepare for a market crash. So first things first, you can't expect to be rich overnight. That old annoying saying that goes around really is true. Time in the market will always beat timing the market. In other words, don't try to time the market. Most people who try to time the market fail, and those who do succeed are honestly lucky. Anytime you buy a stock, you should be trying to hold it for at least 1 year at a bare minimum, but 3 to 5 years is probably where you should be holding your stock before you even think about selling. There's many reasons for this, but the most important reason to think about is that first of all, short-term capital gains taxes are going to cut into your profits significantly. If you hold an investment for less than a year after purchasing and you sell it, you're going to have to pay short-term capital gains tax. But if you sell it for over a year, you're not going to have to pay short-term capital gains tax. In fact, you might not have to pay any tax at all, so you might want to go to the IRS website to see how much in capital gains tax you might have to pay before making any buying or purchasing decisions. And the other thing is, not holding your investments for the long term is probably not going to make you the most money that you could have made if you held your investment. I remember the first stock I ever bought was Nvidia. It was at $200 a share, and I also bought Apple, which was at $200 a share. Those stocks, after I bought them, plummeted, and I thought to myself, I'm just gonna hold, I'm just gonna hold, I'm just gonna hold. I'm gonna recuperate that money, and I'm just gonna sell as soon as I make that money back. And that's what I did. I sold as soon as I made that money back. So those $400 in investments went up to a value of over $1,000. But I didn't hold the stock. I sold because I was scared. The bottom line is I should have held. Make sure that you're adding stocks that you're comfortable holding for this amount of time. Remember, you're holding these stocks for a significant amount of time. So I highly recommend investing in stocks that belong to the S&P 500 for the majority of your portfolio, because these are the companies that are really creating the most profit for their investors. Another thing you need to do in order to prepare for a market crash is to diversify your portfolio. When the coronavirus tanked the stock market, it plummeted over 30% in the course of a few days. But those stocks that were hardest hit were the travel and entertainment stocks that dropped 60, 70, 80%. But there are some stocks that didn't move that much, like Amazon. Amazon didn't move that much in comparison. Stocks like Walmart, they didn't move a ton. Target didn't move a ton. I mean, in comparison to the entertainment stocks, they didn't. So if you had put all your money into travel stocks, your portfolio plummeted 70%. But if you had diversified your portfolio and also added companies like Walmart, your portfolio might have only plummeted 45%. Still a market crash. It's still bad, but at least you lessened the amount of losses. So invest in a bare minimum of 10 companies across several different industries. Don't try to invest in 30 plus companies, because you're just not going to be able to keep tabs on all these companies. Most people don't have the time to. So pick some companies that you really believe in, that you believe are going to really create profit for you in the long run, and just stick to those companies. And a lot of these stocks are going to belong to the S&P 500. These are companies that are really creating the most revenue and profit for their investors. Put the majority of your money in these companies, but also don't be afraid to set a little money aside for speculative purchases. I remember when I had a little money sitting in my account, I liked the stock NEO, and it was trading for about 17 bucks a share. I bought some shares in NEO, and honestly, that's one of my best performing stocks of all time, and that was a speculative buy. So these can be high risk, high reward, or it can be high loss too. Keep that in mind. It's not always high reward. I remember when I bought Aurora Cannabis, and I bought it at, I believe it was 62 bucks a share, and then it tanked to below $10 a share. Now, I would say the most important thing to do when you're trying to prepare for a stock market crash is to prepare for opportunities. So opportunities always present themselves in the market. During a bull run, everything's great. Everybody's buying. As an investor, you're enjoying the ride up. You know, it's just really great. But at some point, there's going to be a bubble that occurs, and everyone is going to realize that the stock market's overvalued, and the stock market is all of a sudden going to plummet. What the average investor is going to do during this time while the stock is plummeting is they're going to sell on their way to the bottom. The best investor is going to buy the stocks at the bottom. So how do you know when a stock has reached its bottom? You simply don't. You don't know if a stock is going to go up or down day to day, but if you're satisfied with the price today, if the stock just went down 10, 15% and you know that this stock is worth more, then buy it. You can sit around waiting, but that stock might shoot up 15%. Other investors are taking advantage of the opportunities that you see, but you're not pulling the trigger. Other investors are saying this stock is at a 15% discount right now. It went down 15% in a day, and I'm going to buy it because I know it's at a discount. And that's what you thought to yourself, but you didn't do anything about it, and that's the difference. Because as long as you have a good fundamental understanding of the stock market behind you, you're gonna make good investment decisions. And you probably won't have to regret many purchases in the long run. Let's look at the previous market crash. If you were an investor and you were looking to add to your portfolio, during that crash was the best time for anyone to add to their portfolio. Because the stock market had crashed over 30%. What I hear when the stock market crashes 30%, I'm hearing that stocks are on sale 30% off. Now, not every stock is a good value at 30% off. Some of these companies are actually gonna end up failing in the long run. So you have to pick and choose. You have to decide which ones are going to succeed. But these stocks and companies are on sale. I mean, just a year ago, when the lockdown first started, Alaska Airlines plunged from about $70 a share to $24 a share. And if you were a smart investor, you bought Alaska Airlines, and then you got to enjoy an increase back up to $68. If you had bought Alaska Airlines, you would have experienced a 270% return on your investment. But let's be very, very clear here. In reality, thinking about your entire portfolio, you did not make a 270% return. These results are unusual. Since they're so unusual, you need to be ready to pull the trigger and take advantage of these opportunities as they present themselves. Obviously, you need to have your emergency savings, but you also need to be putting money aside, ready to invest. And I know what you're thinking. Boy, that sounds a lot like you're timing the market, and you just told me that timing the market isn't possible. You're right. But what you should be doing is dollar cost averaging. You should be investing regularly over the course of time, but also set some money aside. Be prepared to use it if an opportunity presents itself, like a stock market crash. But it doesn't even need to be a stock market crash. It can just be a dip. If a stock dips 10 or 15%, that's an opportunity, and you have to take advantage of that opportunity. So I'm not telling you to time the market, but I'm telling you to have money set aside to take advantage of these opportunities. Because they will inevitably occur. No one knows when, but if you're prepared, you can capitalize in this situation. Speaking of diversifying your portfolio, you know what I think is a great idea? Diversifying the YouTube channels that you subscribe to. Why don't you add me to your YouTube channel portfolio? Go check out my channel. I post a lot about personal finance, a lot about stock market investing, cryptocurrency, all that type of stuff. So go check out my channel, and I think you'll like what you see. All right, thanks for watching this video. Throw me a comment down below. Go ahead and put your own tip down there and let me know some tips that you have for preparing for the next stock market crash. Cheers.